Chapter 11 focus on promissory notes, simple discount notes, and the discount process. You ready to get started? Let's go. When you think about a promissory note, this is a legal. What's the legal? I don't know. This is a legal binding document where you promise to pay. So in this case, we promised to pay after 60 days. The amount borrowed was $10,000 to GJ Equipment Company, payable to National Bank, interest rate at 9%. Okay. It was issued on October 2nd, 2016, due December 1st, 2016. So the promissory note gives you a lot of information, such as the face value, the amount borrowed, which is $10,000, the length of the term, which is 60 days, the date the note was issued, which was October the 2nd, the company extended credit, which is JG Equipment Company, the annual cost of borrowing the money, which is 9%, the company that is issuing the note and borrowing the money is going to be Regal Corporation, and the date and principal, the interest rate, are due December 1st, 2016. So go back. So GJ Equipment Company loaned $10,000 to the Regional Corporation. They agreed to pay them back $10,000 plus interest at a rate of 9%, which is the annual interest rate. The note becomes due in 60 days or 2 months. So when you have these type of situations, we have to understand different type of terminology. When you have what's called a simple discount note, that's a note in which the loan interest is deducted in advance. So whatever amount of interest is owed on the loan, they're going to deduct that amount in advance from your cash proceeds, and you'll get the remaining balance. The bank discount is the interest that bank deducted in advance. And once we figure out the amount of interest, that's known as the bank discount. The maturity value is the total amount that's going to be due at the end of the loan. And this time, when you have a simple discount note, the maturity value will be the same as the face value, and that's because the interest on the loan was deducted in advance from the actual proceeds. Speaking of proceeds, the amount the borrower receives after the bank deducts its discount from the loan's maturity value. And last, the bank discount rate is going to be the percent of interest. So when doing simple discount calculations, make sure you first understand this terminology. Now let's do some actual calculation. So we have Terrence Ryan borrowed $10,000 for 90 days from Webster Bank. The bank discounted the note at 10%. What proceeds does Terrence receive? So first, interest equals principal times rate times time. And we're using 3/6, so we're using the ordinary interest method. So the interest on this note would be $250. That's known as the bank discount. When you have a simple discount note, we're going to deduct the bank discount from the face value of the note, and the actual amount received, or the proceeds received by Terrence, will be $9,750. So again, when you have a simple discount note, it means that the bank discount or the interest on the note is deducted in advance from the face value of the promissory note, and you're going to receive the difference known as the proceeds. Now, if we do a comparison of simple interest note that we covered back in chapter 10 to a simple discount note, from the interest standpoint, same calculations, right? Interest is principal times rate times time. Notice you have the same amount for the interest on the simple interest note and the simple discount note. Bring it down some. Now the maturity value is going to be different because on the simple interest note, the maturity value is going to be the face value plus the interest on a simple interest note. For on a simple discount note, the face value will be the same as the maturity value. That's because once again, under a simple discount note, the bank will deduct the bank discount from the face value of the maturity value, and you will receive proceeds of, in this case, $13,813.33. Compared with a simple interest note, you receive the entire $14,000, and then you will pay them back $14,186.67. Perhaps you're saying, okay, well, go back. Does it make a difference? And the answer would be yes, it does make a difference because under the simple interest note, what we call the effective interest rate or the actual interest rate paid will still end up being a percent. But note with the simple discount note, the actual interest rate paid is 8.11%. Here's why. You're paying interest based upon $14,000, right? But how much did you actually receive? You only received $13,813.33. So when you have a simple discount note, the effective interest rate is going to be higher than the stated interest rate. And that's because the full face value amount was never received. Your proceed would be the face value amount minus the bank discount. So this is a lesson for you. If you're dealing with a bank, you need to know is it a simple interest note or a simple discount note. You prefer to have the simple interest note because if it's a discount note, you're not going to receive the full face value. Your proceeds would be the face value minus the bank discount. And with a simple discount now, note the effective interest rate is going to be higher than the stated rate of interest. Now, just doing a comparison purposes, from 10 to 11, so the promissory note again, 60 days. With the simple interest note, you are paying back the principal plus interest. With the simple discount, you're just paying back the face value amount. The interest calculation would be the same on either one. Maturity value on the simple interest note is face value plus interest. On the discount note, it's just going to be the face value amount. You receive $14,000 for the note, only receive $13,813.33 for the simple discount note. So the effective rate is the same as the stated rate of interest on the note of 8%, but the effective rate is actually higher than the stated rate on the discount note is 8.11%. So basically what this is saying is that most banks will use the simple interest note approach. You're not going to see the simple discount note used as much because in 1969, legislation required that the true rate of interest be revealed. So that means that if you have this type of loan, although they give you the state interest rate, they must also reveal the effective interest rate because once again, the discount is deducted from the face value in advance. So it makes the effective interest rate higher than the stated interest rate. Treasury bills. Treasury bill is a loan to the federal government. So when you buy a treasury bill, in essence, you're loaning money to the federal government. So the terms could vary from, it could be, most of them are going to be short term, so it could be 2 weeks, 3 weeks, 13 weeks, or 1 year. So we're going to look at a treasury bill where the time is going to be 13 weeks. So if you buy $10,000 treasury bill, 13 week, at 8%, how much will you pay and what is the effective rate? Now, when you're buying the Treasury bill, this 8% is known as a discounted rate, meaning that you're not going to pay the full 10,000 for this Treasury bill. You're going to pay the amount for the Treasury bill less the interest on this for this 13-week time period. So interest is still principal times rate times time, the 10,000, the 8%, the 13 weeks out of 52 weeks. You can put that in its lowest term as 1/4. So the interest on the Treasury bill will be $200. That's viewed as being an actual discount. So the amount you're going to pay for this Treasury bill will be $9,800. The amount of the discount is subtracted from its face value to get the cost of the Treasury bill, which would be $9,800. Now, the good news is the interest you're going to earn is based upon the face value of the note, not based upon the amount that you actually paid, which means that your effective interest rate will be higher than the 8% because now the interest amount is here. We're looking at the $9,800 as the principal, the actual amount you paid. This is the time period for the Treasury bill. So the effective interest rate will be $8.16. So in this case, if you're buying a Treasury bill, it's good for the effective interest rate to be higher than the stated rate of interest because now you're earning interest. In the previous example, you're actually paying out interest. So if you're earning interest, you want the effective rate to be higher than the stated rate. If you're paying interest, you want the stated rate to be the same as the effective rate. Okay, that will conclude our discussion on the first part of our discussion over Chapter 11. Stay tuned for Part 2.